You have to start by understanding that the vast majority of dollars that exist were lent into existence. They weren't printed. And this makes all the difference in the world. So what happens when currency is lent into existence is it actually creates demand for that currency in the future. And then what happens if demand goes down, then the debt that created those currency units to begin with is extinguished because you pay off your loan. And when the loan is paid off, the supply actually goes down. Whereas if you have printed dollars, let's say like printed green pieces of paper, and let's say that you lend me $100. And when you just lent me that $100 from that $100 bill that was in your back pocket, you did not increase the money supply. Therefore, when I pay you back next week, I didn't decrease the money supply. But if you're a bank, you would have lent me that money, not by pulling it out of your back pocket, but you would have created a loan, and that process creates $100 that did not exist before. It did not exist. It's just money out of thin air. There's no Federal Reserve involved. There's no green pieces of paper. It's just simply they create a deposit. We call it a commercial bank deposit liability. And then the offsetting asset is just simply the loan that was just created. And so if I pay that loan back, then it decreases the money supply, all else being equal, by the amount of the principal I just paid. So if people kind of get their head around that, then you have to ask yourself, okay, if we have a pie chart of the total dollars that exist on Earth, cash dollars on balance sheets right now, there's no way of knowing this definitively, not even close, but we can kind of assume that if we got $110 trillion global GDP, probably 70, 80 trillion of dollars on balance sheets. I forgot what it was, maybe 20 trillion, something like that. So you got to figure there's at least 50 or 60 trillion of dollars outside of the United States on balance sheets, and almost 100% of those were lent into existence. So let's just assume for a moment that the Saudis change the petrodollar, or everyone starts using the BRICS currency or something like that. Okay, that's fine, but let's just think that one through. If that happens outside of the United States, then you got all these Saudi Arabian folks that don't want these dollars. Fine, but you still have the dollar debt. So what do they do with those dollars? They pay off their debt. And what does that do to the supply of dollars?
Drops it.
That's right. So when you have a currency where the vast majority of currency units were lent into existence, you get into this kind of bizarre scenario where the demand for the currency actually controls supply, and especially if that debt is super short term. So let's say all the debt that created the 50 trillion outside the United States was 30-year mortgages. Well, then velocity would play a role there, because you wouldn't need to pay off that debt right away. Those currency units could circulate all around the economy and create inflation or create the dollar tanking or whatever it is, because you got 30 years before you have to pay that back. But what happens is the majority of debt that created those $50 trillion outside the United States is extremely short term. From experts I've talked to, on average, maybe 2 weeks, a month. So then the other argument, alongside this is, well, let's say they don't have debt, then they're going to dump all these dollars and they're going to come flooding into the United States, and that's going to create consumer price inflation here, or hyperinflation. And I would agree with that a little bit more than the other stuff, or I could see the probability of that being higher than the dollar absolutely crashing, which I think is almost zero relative to other currencies. But you could see that create consumer price inflation or higher consumer price inflation in the United States. But then what you're doing is you're taking all those currency units that are needed for that debt that's due in 2 weeks, and you're bringing them into the United States. So how the hell do they get out? The answer is they don't. And what's going to happen to the value of the dollar outside the United States? It is going to skyrocket. I mean, let's just assume that there's 50 trillion and you had 10 trillion come in because the Saudis no longer want those dollars. Let's just say they don't have any of that dollar denominated debt. Well, somebody outside the United States does. And if those dollars are now trapped in the United States and they're not circulating, you basically have a dollar short squeeze.
How are the holders of the existing debt going to service that debt when the flow of US dollars is going one direction, right?
That's right. Or the same thing can happen if velocity of the currency units outside the United States decreases as a result of, let's just say, a global recession, because those banks are risk off. You're seeing that play out in the yield curve. That's what it's telling you. And then the financial institutions, so they're a lot less willing to lend. And if they're a lot less willing to lend, then what you have is not only the amount of currency units on net balance going down because more loans are being paid off than are being created, but you also see the velocity of those dollars slow down, which means it's even harder for those entities that have that dollar debt to get the dollars they need to service it. And then you say, well, George, what happens if they just don't pay off the banks? That's another argument you get all the time. Well, if they just don't pay off the banks, or if they don't pay off the loans, then the dollars still exist. Okay, well, let's think that one through, because at the end of the day, what's a dollar? It's just simply a commercial bank deposit liability, especially outside the United States, where there are very few green pieces of paper and very few bank reserves, right? That's really a domestic thing on the Fed's balance sheet. And it is true they have access to those reserves through correspondent banking relationships. But most of what happens in the Eurodollar system, it doesn't really settle, let's say, on the Fed's balance sheet, right? So you've got these people that are, or these entities really, that are trying to get those dollars that they need to pay off the debt. They can't, so they default. Then what happens to the bank? Well, the bank that lent them the money, it blows a hole in their balance sheet and they go bust. Okay, but all the dollars that were in existence were a liability of that bank.
On that now default bank, or that now
that just went bust. So what happens to the dollars? They disappear. They're gone. Because all that dollar was just a liability of that bank that's no longer here. So that would be even more deflationary. So all dollars are, with the exception of the green pieces of paper, all dollars are just, they're just a liability on a network of global bank balance sheets. That's it. When you look at the Japanese banks, going back to what has happened more recently, and I haven't followed it the last couple days, but of course we had that huge drop in the Nikkei. I think it was down maybe 10 or 12%. And the next day we had that just rebound right back to almost where it was the day prior. But you'll notice that was the Nikkei. If you look at the index that just represents the banks, I forgot exactly what they call it.
The topics, I think.
The topics, there you go, thank you. Yeah. You'll notice that didn't go up as much. And a lot of these banks, these big banks in Japan, have lost like 25% of their value just in the last week or so. And 25% of their market cap just completely wiped out. So they got hammered a lot more than the rest of the corporations in the index. And I think the reason why is because the market is waking up to the fact that a lot of them have the same issues that Norinchukin Bank had a month or two ago. And that's where they borrowed all of these dollars back in 2020 and 2021 to buy treasuries. So they're borrowing dollars at, let's say, 1%, and they're buying assets that are yielding 3%. So they're pocketing the 2% spread. So, good business. So but the problem there is all those dollars that they borrow in 2020 and 2021, it's not like they're 30-year fixed rate loans, right? These are just loans, again, that they have to roll over every 2 weeks, or they have to roll over every month or so. So they don't have to force sell those assets that they bought with the loans to begin with. So that makes them very sensitive to interest rates. So when the Federal Reserve is raising rates from 0 up to 5.25%, now all of a sudden, we call them your dollar funding costs. These banks' dollar funding costs are at 5% instead of 1%, and they have a negative carry because they're having to borrow at 5%, but those assets that they bought are only yielding 3%. And so that puts them in a very compromising position, obviously. They can't have that negative carry indefinitely into the future, so they have to liquidate those treasuries at a huge loss. And Norinchukin took I think it was a $10-12 billion hit on that. But what's more important is what they have to do next. So what they have to do next is somehow replace those 3% yielding treasuries with an asset that's going to yield more. It's going to yield more than the 5% that they're having to pay for those dollars to begin with. And I'm just using round numbers here just for the sake of the example, guys. These aren't exact numbers. So what do? Well, what Norinchukin did, and I imagine most of these other Japanese banks did the exact same thing, is they started buying CLOs, derivatives in the United States. Okay, well, what's the underlying asset there? Well, it's junk corporate debt And it's things like United States commercial real estate. So let's connect these dots. We see the commercial real estate market completely blowing up. We see credit spreads starting to blow out on junk debt, which means that these assets that in the form of a CLO that these Japanese banks were forced to buy are starting to decrease in value. And this puts them into a position where they really have no other choice but to hold on to them, or just take a massive hit, or just go completely bust. And when you think about the global monetary system just being a network of these global bank balance sheets, if you have some big banks in Japan go bust, that's going to increase the amount of risk, which is going to decrease the velocity, which is going to decrease the dollar liquidity, because that dollar liquidity is not coming from the Fed. The banks create the majority of the dollar liquidity outside of the United States. So then that puts you into a position that we were just explaining before, where there's not enough dollar cash flow, although there might be enough dollars to service the debt. And then you start seeing defaults. And then that makes the problem even worse, because that blows a hole in the balance sheet of the banks that are there to provide the liquidity to begin with. And it kind of puts you in this doom loop.